You want to know how to win in commercial real estate right now, not 10 years ago, not with a lucky deal, right now. The interest rates are up, buyers are scared, and capital is pulling back. Today's guest has acquired over $275 million in commercial real estate, not managed, not brokered, but owned, controlled, and closed. 70 plus transactions, 1,000 square feet of industrial, medical, and retail. But here's what makes him different. He didn't come from Wall Street. He came from wakeboarding on the world stage, world championship podiums, full send discipline. Then he translated all of that into real estate mastery. Nick Jones doesn't just talk about deals. He builds momentum, portfolios, while everyone else plays scared on the sidelines. Today, he's going to hand you the $250 million blueprint, where to find deals others miss, how elite underwriting actually works, and why Florida is his next chess move. And don't forget how athletes think differently and scale faster. You'll either level up from this episode or you'll realize you're not even in the game. So let's get it on with Nick. Nick, welcome to Real Estate Profit Boost, man. How are you?
Thanks for having me, buddy. I'm great. I'm excited to be here.
Good. We've been waiting for a while, right?
I'm just have.
Right.
Few reschedules. That's all right. You're a busy man.
Yeah, we're both busy. We're busy, but it has it. But listen, you're finally here and it's good. By the way, audience, because our audience is anything from a beginner investor all the way to a family office and so on and so forth. I know Nick, again, through an entrepreneurs organization network, and we share the same values, core values, disciplines, and execution strategies. So another EO member, and by the way, I always post this out into the real estate chat, right, for us as well. So again, yeah. Oh yeah, that's right. That's where you and I met.
I watched the show there.
That's right. Okay, cool. But it's casual. It's cool. Nick, we're going to roll right into it. So Nick has an interesting little background, right? So most people don't connect professional wakeboarding to real estate investing. So tell me, how did that journey shape how you see risk, discipline, and deal flow? Interesting.
Yeah, it is interesting because at first I didn't see much correlation at all until, you get to a point in life and you look back and say, what's really gotten me to where I am and what have I seen that I give some advice to other people possibly. And wakeboarding, like almost every other sport, it just takes so much work. And, when you're in junior high, high school, even college, like there's not many things you want to work at as hard as a sport. So the people that are in sports, like they're putting that time in, they're putting that effort in, and they're seeing the benefit. Winning is probably one of the most fun things you can do. And winning in sports with, teammates or, at a world stage is almost like intoxicating. You get these endorphins released. It's such a, something that you want to push hard for. So being, in wakeboarding, which is the sport that I picked, and training, for 10 plus years, almost every single day for, a handful of competitions once I got to the peak was a valuable lesson that when I retired from it and I kind of started at the bottom in real estate, I'd seen where I can get to. I'd tasted what success, what could be like. And, I just wanted to push as hard as I could for it. So it gave me the opportunity to keep my head down for, my first 10 years in real estate and work during the day and then at night study, most nights, to get to the point where I could excel my career, to the point, of a high level of success. So I'd say that's the biggest
100%.
thing in sports is, you just get to work your ass off and, you do it at a young age. So you kind of get it ingrained in your DNA.
Right. It's the discipline because it's school, it's the discipline, it's the wakeboarding, and it's everything. So tell the audience a little bit about your record. You've made it to many podiums on a world stage, correct?
I did. So I grew up in Seattle, Washington, and I moved down to Florida after high school to pursue, the professional stage. And I rode professional about 7 years. At my
Wow.
peak, I was on the USA team. So we were traveling the world, competing across Asia, South America, Europe. And, at my peak, which was 2011. So I'm dating myself now, quite some time ago, but, I was third at Worlds and I was doing the world tour, getting, various other podiums. So on the tour, I was fourth overall. And, it was an awesome time. We were doing a bunch of video shoots everywhere, photo shoots.
Right.
And as part of it, you just see such crazy things. Like, I remember we were in Malaysia and we were wakeboarding on a river. A crocodile ran out of the river that we were competing on into a jewelry store across the street, and they'd, like, shut everything down. The cops had to come and pull the crocodile out, and
Right.
then when they resumed the contest, they're like, "Okay, guys, you're ready to go." We're all like,
Yeah.
"Wait a minute. We're not gonna jump back in that river." They're like, "Oh, it's fine, it's fine."
Right? The crocodile running into the jewelry store and you're zipping through there. But
Yeah.
wakeboarding, I mean, you're talking about flips. You're talking about serious stuff, right? This is an adrenaline sport. I mean, I think it's awesome. I grew up in Michigan, so we always were on the lakes, right? But we didn't have wakeboarding, so I'm going to date myself, right? We used to have I think slalom skis is what we call them, right? Skis
Yeah.
and a single skis. Wakeboarding, when my kids went to camping up North Michigan, they came back wakeboarding. That's like when it was born, right? Getting it. But we used to get up on like it looked like an arrow ski, right? That was like the first wakeboard with two little things. You had to hold it sideways, and it was this narrow.
Yeah,
So
it's called scurfing.
Scurfing, that's it.
Yeah.
No, I remember, I remember. And you do bring up a good point, right? And this is another thing that I've heard from several other entrepreneurs. There's a guy in our chapter down here who built a logistics company in EO, and he sold it for north of $100 million out of Albany, right? And logistics meaning trucking, right? And he only hired D3 athletes, right, from certain schools that never went pro. And he turned them into sales machines. That was his secret sauce. They were out knocking doors and things like that. And let me ask you, your hiring practices now, do they revolve around sports at all?
We definitely look for athletes,
Right.
100%. They understand how to work in teams. They understand how to work together, and they have that drive that we were talking about.
Uh-huh.
Um, so it's people that, if they got to professional, that's a huge advantage. If they played in college, that's great as well. And even ones that still want to do it. It's a lot of it's that competitive edge.
Right. No, I get it. So, like, for me, like, I once spoke at a like, it was a thing for college and stuff, but my topic was that passion is bullshit. Like, meaning follow your passion. Right? When they say that, I said that's the biggest lie you're being sold. Why? Because, for example, Nick likes wakeboarding. He went out there one day like I did. I was skiing right behind boats. Next thing you know, you start to like it. You start to get good, and the better you get, the wins give you the confidence, right? And then the dopamine hits. And then you're like, I want to do it more. Then I want to do it more. Then you're disciplined. Then you start competing. And then guess what? Everybody says Nick's passionate about wakeboarding.
Yeah,
But
exactly.
right? But most of the time you hear the follow your passion. Well, you don't know your passion until you get disciplined, good, and you feel the win, right? So it's interesting.
Yeah, we noticed that. I grew up in Seattle, and wakeboarding in Seattle's miserable,
Cold.
challenging, cold. Like, I wouldn't do it now. At this age.
Right.
But myself and so many other riders that came from around the world down to Florida, which was the hub for the sport.
Right.
We got down here, we had such better discipline because our environment was terrible that
Ah,
as, the local riders who were just used to perfect, weather all the time, there'd be days they'd take off, they'd kinda, just relax, where a lot of the guys from around the world that were in climates that they should not be professionals, they got to the highest level because of them understanding discipline rather than just passion.
wow. No, that's very interesting, right? Bill Gates's town is Seattle. But it's interesting
Yeah.
because your environment kind of shapes your discipline, your tolerance, right? That's interesting. So coming from there and coming here. All right. So now we're going to take all this discipline from the sports world, and now you're going to find out exactly why Nick is in real estate and how he did it and so on. So what was your, I'm all in on real estate moment? How did you go from wakeboarding to, boom, the shift from a podium to a portfolio, let's call it, right?
Yeah, so I lived with, 11 other wakeboarders in a large house that, one of the wakeboarders' fathers owned. And so it was somewhat like a frat house of athletes. It was on a lake here in Central Florida. And, the guy who owned the house was, in real estate. He did some brokerage, some development, some hotel flipping, kind of a little bit of everything. He was the one that I was talking to, who got me an internship at a local real estate brokerage house. And I
Got
was
it.
I was going to college for real estate. and I was kind of like leaning into it at that point. Some of my professors are really key as well, kind of bringing me into it, making it seem like a really
Did you do it
fun.
because of the guy who owned the house? You had a mentor? It was your environment?
He was the
Kinda
one that got me into the industry through my first internship. I'd say that the closest initial mentor I had was the dean of our real estate school at UCF, a gentleman, Randy Anderson, and he'd started the real estate school there, had built it up. His son was a pro surfer, so when I was in class, we really connected. And what was great about him was he was an academic, but he was also, someone that was out there, doing deals, making moves, building a company. He actually left the UCF real estate school, years later, and went off to raise a fund of funds of sort, and was incredibly successful in it. Built it up and sold it, and now he's back growing the USF real estate school. So they
got
just
it.
brought him on to run their program, and I've joined him on the board. So for me, that's a really cool, full cycle type scenario. But
Love
he was
that.
one of the big motivators. Then I got pushed into internship through the gentleman I lived with, and got into brokerage. And in brokerage, my a mentor there as well. So obviously there's a trend, right? Mentors in real estate are critical because you can learn a lot in books, but you learn a lot about people, which real estate is a people business, by being around it, seeing the deals, understanding the emotions of the negotiations. There's so much to it that, someone who's been doing it for 10, 20, 30 years can teach you.
Commercial brokerage or
Commercial brokerage,
residential?
yes.
Okay, got it.
Commercial
On
brokerage. So
a big name that we know or no? Just curious.
my broker was Susan Morse that I worked with, and so she was kind of the queen of I Drive in Central Florida.
Got it. I remember. Yep.
Yeah, she
International
sold.
Drive.
Oh my gosh, she sold half of the hotel sites down there. When I got thrown in, we were selling a resort in Hawaii, one down in the Bahamas. So she definitely just threw me right in and said, "Hey, you're gonna figure this out. You're a sharp kid." And it was at a time when selling land as well was really hard. It was like 2010, 2011, and land in Florida was not the most attractive investment. So it felt like we were selling timeshares. People were like, "We don't want to talk to you. Get the heck off the phone." But eventually, when the market started to turn, developers started calling us back, started wanting to have conversations, and so I started to kind of get the idea of what developers were looking for, hear how they talked, see the projects they're looking to do, and it was just incredibly fascinating. To
I
the
see.
point where
Go
I
ahead.
wanted to learn more from them and hear about them and see their pro formas and kind of talk shop with them. And these were mostly multifamily at the time, multifamily and hotel. And I just absolutely loved the way they talked and worked, so I figured I wanted to go in that direction.
See, no, that's awesome. See, for me, Orlando, like I'm mostly South Florida. I own some stuff in Atlanta. I own some stuff in Texas. But for me, whenever I go to Orlando, it's so hard for me to understand that market, right? Why? Because number one, I think you got more hotel rooms in Orlando than I think anywhere in the world or something like that. You probably know the stats better than me. Then number two, you've got iDrive, for example. Then you've got Bella Buena Vista. Then you've got Phillips. Then you've got Universal. Then you've got this, and there's a ton of land, right? And even today, there's massive parcels on the south side of iDrive and so on. And then it's like you have old 1980s retail. You got old, and then you got new construction. Then you got this. So to me, like for me, I think because I'm stupid, because I came from Manhattan, when I look at South Florida and I look at trends, right, of people migrating, right, I see that 1,000 people are moving down here a month or whatever it is a day, I think, right, a week, something like that. Don't quote my stats yet, but and I see the Everglades on one side, and then I see the ocean on the other side, and I see a developable piece of land like Manhattan, and I've been investing in South Florida for 22 years. And guess what? Everything is getting more dense zoning changes, right? So it's like, and now all the low income housing has been displaced out where all I was doing was buying workforce housing and things like that. So how do you get a grip since you've been in that market that long? I didn't know that on that Orlando market. What do you tell me about what you think about that and how to actually find the right deal there, especially in retail or hotels with all the competition?
So the biggest differential you're talking about is the geographic boundaries that you have on the islands or down in South Florida with the
Uh-huh.
Everglades. You do have some of that in Central Florida with wetlands, but you have to be careful because wetlands can be mitigated. Political polls can change things that couldn't be developed into being developable. So then it comes down to just other factors you have to weigh in, heavily on, and that can be traffic patterns. It can be household density in different markets. It can be for retail, how close to various hotels you are on their routes to and from the theme parks. So there's just different factors you have to focus on in order to protect your investment. But on the other side of that coin, the fact that we have so much land creates such opportunity for expansive developments that on the retail side, when you have new households coming in, because they can just keep on building, 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 they
Right.
need those service type, whether it be food or basic retailers. So there's a lot of opportunity to do greenfield type development that just doesn't exist in South Florida. So in South Florida, if you're wanting to go build a Dutch Brothers or a Starbucks, you may have to assemble 2 or 3 small sites from various owners who've owned the land for generations, and that can be an absolute nightmare. Where in Central Florida, it could be, at an intersection of a road that they're building at the time. And it's, you're slicing off an acre or two from a farmer who's saying, sure, you can take it. And,
Right.
it's a completely different type of game that, has its pros for sure.
Right. And most of that's all around the residential developments, right? But I'm sure since there's so many residential developments or gated communities, let's call them golf course communities, right? They're in permitting years before. And I'm sure the competition knows, let me pick off that corner or those out parcels, right? It's got to be competitive, no?
It is. And so that's just another part of the risk equation. The earlier you buy in the development cycle, the more risk you're taking. So that has to be part of your business model and it has to be something you're comfortable with. If you buy something as the entitlements are being pulled for a housing subdivision, well, I mean, you could have to wait 15, 20 years if there's a recession or if, lending gets locked up. If you wait until those houses are built and then the retail land is there, you're going to be paying a lot more for it, but you're also mitigating a lot of that risk because the households are there. The people are going to be coming in, especially if they're already sold. So it's just different levels of where do you want to make your profit and how much of it do you want to
Got
have
it.
be on the front end speculation relative to kind of back end, ready to go type scenario.
Right. Right. But obviously, you like Florida. You're still doing things in Orlando, correct?
We really like Florida. We like, a lot between Central Florida. I mean, we're investing heavily from, Cape Coral up through Tampa, Orlando, Jacksonville. There's just so many good municipalities with a lot of growth. It's somewhat business friendly. Our tenants all do really well, so their sales are really positive. So they're wanting to grow as well.
Gotcha. Gotcha. So before we get into your current portfolio and stuff, tell me about, coming out of that mentorship at the school and everything. What was your first real estate deal that you ever did?
Yeah, absolutely. So this was a fun one. I was a broker at the time, and a lot of people talk about wanting to do deals. And I can tell you that being when you're a developer, it's just a lot of work. There's a sexy part that you get to talk about, possibly things like this, but then you're just in pro formas, you're in spreadsheets, you're doing just talking to municipalities, going through permitting, pulling your hair out for, probably 80% of the time. And so when I was a broker, I wanted to, start doing deals like most people out there. And so I talked to all my friends who were also fellow brokers. A lot of us were all UCF grads. And one of my friends that I was close with was this guy Billy Rodriguez, who is still a broker at JLL, a retail broker. Actually, he and his team are absolutely crushing it right now. But I was talking one day about wanting to do a deal, and he said, "Well, I know there's this Taco Bell out in Apopka, which is a suburb of Orlando, and I think there's this tenant Legranja who may be interested in it 'cause it seems like it fits." So
Got
I
it.
went out there, tied up the Taco Bell. We went and talked to Legranja and they're a South Florida concept. At the time, they were a lot smaller, expanding. I think now, they've been expanding ever since then. And this is when I started my career. So they've had a really good run of success.
Yeah.
But while under
They're down
contract,
here.
I signed, yeah, they're down there. Yeah. So I signed a 10-year lease with them. And all I had to do was replace the roof and put on new HVAC, which now, we snap our fingers and we could do it overnight. At the
Right.
time, it was like I was building a whole new building. I was I was definitely learning by doing. It was probably the hardest roof and HVAC job I've ever had to do, but, it's you cut your teeth by being thrown into the moment. It
Hmm.
was also a really good time to be doing deals. I got 80% loan to value on my debt, interest only of around 2%.
And you said you tied it up in the contract. This is a trick, right? Because people learning from real estate profit boost. While you were in contract and due diligence, you secured the tenant. Is that what I heard?
Correct. That's
Right.
correct, yeah.
So you removed your risk if prior to closing, or no?
Exactly. We removed
Yeah.
our risk. All we had to do was follow through with our business model. And
Okay.
that's a big trend we follow. It makes it for hectic moments of time, but once again, when you're investing, all you're trying to do is recognize your risks and then mitigate as much as possible, and
Got it.
have them the ones you have left have them be asymmetrical, so that if something goes sideways, it's only partially sideways and doesn't take your whole investment down.
Right. So Lagrange, you could negotiate and sign a lease even prior to closing. They didn't go to the due diligence, or they knew you were in contract and still had to close. Because think about it. A first deal, a lot of people are listening here, and Nick basically, uh, uh, you know, he removed his risk. He tied it up in contract. And if I think I know what he's going to say, he may have even got a lease deposit before closing. So there was his down payment money. Now that would be a perfect deal.
That
No,
would be
but
impressive.
that
Oh,
would
we
be
we got
impressive.
almost. We almost got there with that. No, we didn't get the
Right.
deposit, but we
Right.
did get, the lease signed. And a big part of that helps with the debt. If you're buying a vacant
Right.
building, there's no chance you're gonna have of, getting 80% loan to
100%.
value.
Yeah.
So the tenant is key, and it's a lot of negotiating various angles that other parties aren't seeing all at the same time. You're negotiating the debt, you're negotiating the land contract, you're negotiating with the tenant on the lease. Then you're also, getting your vendors lined up so you can make your projections on what they need right on time. If
How
you're
did you
raising
get the
equity,
LTV if you didn't have the lease signed? And where'd you get your first capital too? Because they're going to ask the audience, like,
yeah,
where'd you get the
so
first 20%? How big was the deal
it was
size?
it was small. I think our total equity was 180,000. So
Okay.
myself
So,
and my brokerage partner were able to put it together.
okay. Got it. And you got the bank to understand that you're going to secure a lease, I guess, something like that nature? Or was
So
it
what we
contingent
know
on the lease? Yeah.
it was. So you tell the bank, we're going to secure the lease. Here are the terms. They go through the appraisal process, everything, assuming that the lease is signed.
Uh-huh.
Meanwhile, you're working your butt off trying to get this lease signed, negotiate it. No one else cares about your timeline other than you, right? The tenant, they care about their timeline only. Sometimes they're quicker if they know that there's a deal and there's maybe a competitor who could take it to another tenant. But, you're kind of juggling all these balls all at once and hoping that they fall, in the right order where you can get the lease signed and then close, have your, contractors ready to go on the construction. Because once you close on the land, you have carry costs or on the building. So the day that you close, you want to start, doing the roof work. You want to start doing the interior work. Because after you do your work, then the tenants need to do their work as well to get to open. So you have this carry cost time that is,
Right.
contingent on your performance.
And then the tenant negotiates with you. What a lot of people don't get is you may be giving 3 months of your rent, your first 3 months away, right? While
Easy.
they get
Yeah.
going, right? 3 months, 6 months, and stuff like that. So when that all like a lot of people don't understand retail, right? A good friend of mine, Mike Rector, owns a lot of retail, all over the state too, Vero Beach and so on. And then my first retail deal, I brought him in for 25% as a partner because he loved my deal, right? But I didn't know how to do everything that you're describing. And I saw it, right? We had to give, the tenant this, the tenant improvement that. We did this. We said, hey, we're good. So that first deal, first of all, what kind of cap rate were you underwriting to on the retail side for something like that?
We're
Ballpark.
probably 8 or 9 trying to sell it,
That's
7.
strong. Okay. And you underwrite the first 6 months as stabilization, or how do you do that? Because you're not getting the cash flow at least 6 months, right? Let's call it.
So we bake our carry cost as a line item into the deal,
Okay.
and we underwrite what it looks like stabilized.
Understood. Okay. So, and for me, like, and you're going to tell us your tricks, right? I never did anything except for value adds, right? My biggest play was I did around 110 condo conversions when, this is during 2005 when, when
Good time.
anybody could, yeah, it was 2005 when I was going to say anything from, there's no Uber driver, a taxi driver to a stripper got a loan, right? Anything with 1% down, right? But and why do we do that? And that was a pain in the butt with the permitting, right? And everything like that. But and now on the retail project that I got involved with 3 years ago, the contractor, the change orders, the city delay, like it literally, even on that deal with an experienced partner and operator, we were 5 months off. because when we did the inside tear out, we thought a wall was structural, but it wasn't. It didn't have rebar. It was an old oil place where they blocked up one of the doors, right? So then we had to go back to the engineer, back to this. How? That's why I don't do it. Tell us you're not afraid, right? But for me, if we didn't, we had an IO loan seller financing. The guy was easy. It was cool. So we had playroom, right? You know, we weren't getting killed. We were 5% IO. And our whole cash out refi strategy, and then leave a 6 cap. That's what it was, and to lease it up. But how do you tell us what you learned about that, or tell us a mistake? Tell us some tricks of the trade on how you deal with that, because that's the fear. Even on my condo conversions, we're never on time, right? And that really bit in. And how do you underwrite when the city's being a pain in the ass, or the inspector's a jerk and sends you back for 31 reasons for no reason? Give us some of
Uh,
these, you know, early moves, mistakes, learnings that built your foundation.
I mean, all the problems that you're talking about, I mean, we're literally going through half of those right now, and it's that's what I'm saying you pull your hair out for. So it's, you have to make sure you underwrite your contingencies properly.
Got
And
it.
I mean, even early on, I'd put a contingency in there and then I'd kind of take it away and see what the return would be without it. But you quickly start to learn like those are real things that are going to come up. And a lot of times it's time. And a lot of times it's, with redevelopment, it's tearing things out that you didn't know was built a certain way and you got to catch it and rebuild it. On ground up, it's site work. It's kind of a lot of unknowns in those areas. So early on, I didn't take contingencies as serious as I do right now. And with every deal that we complete, we go back and we say, okay, where were we relative to budget? Do we save money on contingencies? Were there things we didn't see? And so we look at all those. The One of the bigger things that I've learned over the years is we are really loyal with our relationships of the people we work with. And that is, everyone from, our brokers to our environmental consultants, our contractors, our architects, our attorneys who are running title, because when we have all those eyes looking at the site ahead of time, it
Got
really
it.
helps us uncover things. And it's the point where like our GCs, they'll walk the sites with us before we close. Our roofers will go look at it. Our phase one guy will give us kind of an early glance. Sometimes our attorneys will pull title twice because it just seems like it's too clean. I mean, there's been several times our attorneys have gone on their own, pulled the title twice, and found things didn't get pulled up the first time. And sure, there's title insurance for that, but if I'm going back and forth on a title insurance battle, meanwhile my tenant can't open, so then I look bad, it's
Right.
like I'd rather, get things right than win per se if, I get in a legal dispute over something like that.
Right.
So,
No, I get that. That takes years though, right? To establish, like I always people like, so now that, I own and operate real estate, and then I own the insurance agency and all that good stuff. I have a network of good electricians. I have a network of roofers, right? But I'll tell you, you know how many electricians screwed me, right? So in the no, but like, you've been doing
yeah,
this
it's
how
true.
long? Right. It's like, you know how many bad electricians I had to get to the one good electrician, or the two, right?
Yeah.
How did you mitigate? What were those key lessons, or like biggest mistakes that you learned about, so you can, if somebody's starting out, like, and what to avoid? Like, how did you build those long-term relationships like that, with just a trial and error?
Well, so I guess first you asked about the biggest mistakes. I'd say the biggest one that I've made, or the ones I've thought about is making assumptions and not appreciating, what could go wrong if those assumptions don't go right. And I see that still all the time when people underwrite deals and they'll share with me where they make, assumptions on, well, if the market rate is X amount for a tenant and we lease it at that, we'll make this much. But they
Got
don't
it.
understand the depth of the market. Or, we got one quote for, this improvement and it looks like this. But it's a GC they haven't worked with before. So a lot of times you really have to just make sure your assumptions are accurate and something that can be backed. And ideally, you just, get rid of those assumptions. Either you sign the contract with the GC prior to closing, or you find your tenant, prior to closing as well.
Got
So
it.
when I've made assumptions that are, somewhat overly bullish, that's where, you start to get cut because, it just wears down whatever it may be on your contingencies and then your overall, project budget.
Right.
As far
So
as the
you
relationships,
beware the pro
relationship
forma. Is that what I'm hearing? Right?
Yeah,
Especially,
yeah.
you see brokers, they love the pro forma, right? That's
Never
what it's
trust anyone
saying.
else's pro forma. That's for damn sure. Yeah, I mean,
Okay.
we do all of our own pro formas. We still do everything in Excel because we like to see how every equation's built. We go back through and check it, and you really have to own your pro forma. So whether it's me, I mean, I have an acquisitions team, and they build out their pro formas. We're checking each other's work all the time, and there's got to be a lot of ownership in that because if something's off on that, I mean, it transitions in the real world pretty quick once you close on a property.
Right, right. No, 100%, especially right. Yeah, I mean, you could try to push the limit, right? Like with the retail project we did, we didn't think we are going to get over 45, 48 a foot, but we got 55. We went out at 60,
Wow.
but we were willing to go vacant a little bit, right? And since we're the landlords, we also took out the wind on the property. Why? Because it's a 1957 structure. It's solid concrete building roof, this, and we put in new everything. So we waived the cam. We got so we dropped it. So we had a little lever there, but we got to 55 a foot. And by the way, when we bought it, it was $30 a square foot. But again,
Wow.
downtown Fort Lauderdale. Yeah, right.
So
175
you,
feet on
you brought
code.
up such a good point. Is a lot of people don't think about cams because they're pass throughs on retail.
Right.
But for the tenants, I mean, it doesn't matter if they're paying us or if they're paying the expenses. It still costs them. So if you can create a lower cam for a tenant, I mean that goes back to the rental rate for them. And with
100%.
the environment we're in right now, I mean, cams are going out of control. So controlling that's a huge value add that people, are underappreciating, I think.
Right. No, and I hear a lot of the same from you when we were talking, but for us, everything is operations, right? A real operator understands NOI, right? And you have to have a strategy. Like that's what I find in real estate. Like even like the brokers, they have no strategy. I'm talking to a broker at well, some of them they're good, but
The
I'm
good ones
talking
do.
to right, like they do, but they don't. Meaning you're competing, let's say CBRE and like a Marcus, right? And they're coming to sell your property or something that or lease it up. I'm like, so why should I go with you? Well, because I know everybody. Or why should I go with you? Well, because we're CBRE, we have the best research in the industry. But that's not it doesn't give me data. It doesn't give me something to objective to grab onto, right? So, for example, what we do in our space, right, is hey, listen, why don't you pull a couple NOI levers, right? Come see me and say, hey, if you're paying, if it's one water bill, one water meter on this retail that's 12,000, some landlords are paying that. Well, why don't you use rubs, right? Redo it, translate that into a higher NOI ratio, utility billing systems, things like that. Or for us, we do it on insurance. So we pair the right capital market like life cos, credit unions, no Fannie Freddie, because they'll kill you on insurance requirements. You're paying 80% over for no reason except for a non-recourse loan and so on. And that's what we do. So we increase NOI. In fact, the best one I've seen besides insurance was Tiffany Mattel. She just moved here, Florida family office. She started a company called Utility Ranger. She's on one of my podcasts. She had let's just use 100-unit building, and she came up with a fancy calculator called the Utility Ranger, and she billed back water and garbage. But it was $71 a unit times 100, right? Per month, right? So I was like, just
Straight to
like
the
you
bottom
said,
line.
straight to the bottom line, like 90 grand, right? I mean, come
Yeah.
on. So it's like, I think I'm hearing it from you. Sometimes you don't need to buy more, right? But be a better operator. Would you agree? Because everything you say, by the way, I'm picking up. You're very, asymmetrical. We do our own performance, our data. You need to know the depth of the market. What I'm hearing from you is a very analytical, data-driven mindset. Am I correct?
I mean, you have to be because you're a home run in real estate is, still, a 2, 3x, maybe on a deal. Most of them are probably, depending on your hold period, one and a
Right.
half to 2.5. So
Hmm.
if that's the range you're playing in on your return, you have to be looking at every single lever you can pull and be
Hmm.
completely analytical across the whole, investment, development, hold period, and then exit spectrum. And if you leave anything on the table, and it's not like you're taking it from anyone else, you're just really refining your processes and making things super efficient so your tenants and your property show in their best light that they can. And you got to do that before you scale. I mean, if you don't build those systems when you're smaller, you're just gonna get lost as you scale, and you're gonna start dropping balls, and it's, it can get ugly really quick.
Gotcha. Did you experience any kinda, like, hyper scaling where you had to pull back a little bit?
We experience. I would say no, we didn't have to pull back, but we definitely experienced the time that we had to put the work in to build out
Mhm.
processes. And
Got it.
I mean, it's interesting because when you first start to do things, at least for us, we saw it as kind of like an art, and you can really distill art down to processes almost across the board. So a lot of what we did that we thought made us unique. I mean, we just were able to put into processes, and then have, as our team expanded, have them have those different processes, keep things in line, and then on that we just
Got it.
leaned on our relationships.
How big's your team now?
We have 14 people.
You have 14 people. Okay, and you control today what, about $275 million portfolio? Retail?
Portfolio right now is around 230, 240.
Got it.
Obviously we're always selling property, so I think we have 10 on the market right now.
Got it.
We have several under development.
Okay. Is there something? Because again, I hear your data, like, when you speak, and by the way, for me, I mentored at, Miami University of Miami Launchpad, 8 years ago, right? It was a bunch of kids, and I liked it, but they had an event. It was the chief engineer of Facebook, and I'm like, "I don't wanna go see the chief engineer of Facebook. I don't wanna hear about coding." That's what I was, and my so I went with these mentees, and I sat there, but my biggest takeaway was the culture at Facebook. There's no arguing, there's no fighting, there's blameless problem solving. Data makes all the decisions. That's what they did. And that was my biggest takeaway. And they remove emotion. So to me, I'm hearing that from you, just in your language. Do you have some way that you underwrite differently that maybe, others do not? Because I hear it. And you're saying you even validate your team's data. You said, they need to know the depth of the market. They need to know the rates. They need to know the rental rates, this. And then you say we check each other's data. It sounds like you underwrite differently, or you have backed SOPs, right? To validate a lot of data. Tell us about that, because this is the
Yeah.
secret sauce, folks. It's the little details that matter.
Yeah, I mean,
Right.
I mean, notice kind of, you talk about it all across business, is as business gets more complicated, you really get good at it when you distill it down to the basics. And so that comes down to how we underwrite, how we have our SOPs built out, how we communicate as a team.
Mhm.
There's a book called the Checklist Manifesto that I read years ago, and our whole team read it. And have you read it?
No, I'm
It's
about to write
really
it
good.
down. The check.
Yeah, it talks about how
Huh?
the
Go
Checklist
ahead.
Manifesto. Tim Ferriss talked about it at one point, and
Tim Ferriss. Yep.
what he was saying is, the airline industry, now medical industry, they have all these checklists for things that they should know that are standard. Where I used to create, checklists for more complicated type things. But their thing was, these professionals, they have enough to worry about. They have more complicated
Mhm.
things to think about. So the standard things that they go through, just have it built out. So we started building checklists out for kind of all the scenarios on acquisitions. And so we never like miss anything. Like nothing really slides through from our initial underwriting of a deal. So
Right.
that's
Love
the
it.
first
Yep.
part. And then when someone's underwriting, whether it be rents or the market, we distill it down to just really clean information that someone else can look at it. And it's not like they have to go through and read all the data behind it, because we trust the person who's putting it together knows what they're doing. We can
Mhm.
look at their results and say, okay, this makes sense. I see how X plus Y got to Z. And so that's helped us as a team operate and continue to underwrite deals and really expand underwriting deals, because it's really hard to scale acquisitions. So that's been a big
Yeah.
part of it. And then we're just, somewhat
Yes.
conservative. We
Right. It's hard to scale acquisitions.
really
Interesting. I
hard.
like. Yeah. Why do you say that? Give us some feedback.
Well, because a lot of it is based off relationships on the front end. So,
Okay.
just getting
Brokers,
to
people.
see
Right.
the opportunities. Then you have to underwrite them quickly, because whether it be on or off market, we're probably 75% off market, 25% on the things we buy, but everyone's looking at them. That's there's
No,
not
I
very
get
many
it.
times you have something off market that no one's
Right.
looking at. I mean, there's a group of competitors that, we're familiar with, other developers that, you constantly kind of hear through the grapevine that they're looking at the same off market things you are. So there's a lot of efficiencies in how properties are getting out there. So
Right.
you have to have the relationship, you have to go through it quick, you have to get your numbers, quickly as well. So there's just a lot of things that you have to intrinsically be very professional and have experience on. in order to do acquisitions. It's hard to come out of college and just sit down and say, okay, we want you to play with our money, and you may risk $100,000, on due diligence before we move forward, and just don't mess up. So we
Right.
create these systems and kind of guardrails to help build our acquisitions team as quickly as we can, in their professionalism.
No,
And
listen,
then we underwrite conservatively.
that's huge feedback, right? Because I agree with you. So Jamie Sturgis, you may know him, Native Realty. He was on my podcast, I don't know, about a month ago. He's a retail king down here. Um, he's got different strategies, but he says I got $100 million in off-market deals. But the right relationships get them. But the other side is everybody knows those pieces of dirt, especially in an urban density setting. And I have the same problem. I have a mentee who's he's 32 years old. He works for me, Justin, and I taught him how to do acquisitions in the multifamily. And I'm okay with base hits, doubles, singles, right? Like a fourplex, a 20plex, a 50plex, right? And he has a contract in his car, right? He writes cash deals. We write 5-day due diligences, and we bought one property in 9 months, right? And it's not a home run. And anything that's over 20, 40, 50 units or size, everybody knows it exists, right? And everyone's cold calling on it. Now they got a room, Philippine call rooms. We got texts. I get 5 texts a day, right? To sell my property. So it's interesting because there's a lot of people. I have a friend of mine who's a doctor, eye doctor. He took a real estate mastermind with those 2 guys in Florida, I forgot their name. And like this guy's been throwing offers for a year and a half, right? On industrial medical. And he's like, and I'm like, Gary, dude, you just either just buy something, right? So you can figure it out and look for different NOI levers, or how do you get creative? How do you bring a value add or whatever it is, right? People, I've seen crazy creative stuff, zoning changes, drive through, whatever. But it's interesting. When did you come to that conclusion? Or did you, that's when you shifted development, I'm assuming, right?
Hey, I just lost you. I don't know why, but I can't hear you.
Shit. Can you hear me now?
There you go. You're back. Yeah.
It's my shit connection. Andres, did you get me? Where did I cut off? I don't know. Did you hear me when I asked you about shifting to development?
No, I didn't. So it's right as you started going to that. Honestly, I lost it.
Stupid internet. I knew this was gonna happen. Okay. You can hear me now though, right? Clear?
Oh, now you're back to 100%.
Okay, cool. All right. So what I'm hearing is, from your comment, it's very difficult to scale acquisition. And I've seen so many people suffering with that, especially in the last 5, 10 years. Our clients, syndicators, multifamily, retail, they can't find anything. Is that why you switched to development?
No, I mean, that's definitely a reason to switch, because development has just different risks and challenges.
Mhm.
What made us switch is we just underwrote how we looked at putting the deals together. So we started with value add investment, because we liked the idea of buying properties that had in place cash flow. And
Right.
then
Me
we
too.
had to renovate them and pump, rates up, whether it be because, we're repositioning the property from C to B or B to A, or there's an inflation play, which is something we really enjoy right now, where we're just, pumping the rents up and cleaning things up. So that was a strategy that we liked, because the steps between stabilization and where we acquired it were a lot less. And the risk factor, if something changed in between, we could stop with, rents where they were and not lose the property. For development, you're buying a piece of dirt, and until there's a building built with customers there, you're not making any money. So there's a lot that has to happen.
Right.
What got us into it was, through some of our repositions, we met some really high quality tenants that were proved really great to work with. And, we enjoyed having them at our properties. And we had some opportunities to build some ground up scenarios for them. And so we dove in and quickly realized that what we perceived as, potential challenges, we could mitigate with, the right team. So right now, a lot of the ground up projects we do are single tenant net lease, where we're working with, some of the top credit retail tenants in the country. And we just build a team with expertise around working on that type of project. So, we're working with Dutch Brothers, Chipotle, various
Mhm.
banks, some preschools on some deals. And when we
Got
go
it.
into these deals, almost everyone on the team has performed more of these projects than we have. So it's just like second nature for them. So that's, our GCs have built dozens of them, our architects, our civil engineers. So a
Got
lot of
it.
the risk in that regard is limited, especially with our project budgets. And where we see the risk is, on our site work. So it's just looking
I
at the equation differently.
understood. So basically, you made some good relationships with the tenant, right? And then that tenant said, "Okay, we want more, stores or whatever it is." And then did they say go out and find it? So you almost, worked for the client, or was it vice versa? You went to them and said, "Hey, let's work on expanding," and then and so on and so forth. Tell me where that switch came, and how it happened.
Yeah, so a lot of it is we go out and we look for them, and as we get
Okay,
better understanding the demographics, the site characteristics they want, it makes it easier for us to find the site. But beyond that, once you've done a few deals with them and you find the site, then you're a trusted source for them, and that makes a big difference.
there
Because
you
for
go.
them,
Okay.
all they care about is being open and, servicing their customers. They don't
And
care about
their criteria, and then
and we know
you
their
right?
criteria.
Right, their criteria, locations, this, so you have a guy in-house that does that all day long? Look for sites?
We do. We have guys in-house and we have, brokers that we work with who, they know more about the market than we do. But we just
Got it.
try to make it as easy as possible for these tenants to open
Mhm.
without, as little conflict as possible. So
Right.
ease it for them.
That's their biggest pain point and your biggest pain point, right? The quicker to open, quicker to make money, right, so on. Okay, but are you your own GC? Because you keep saying subs, GCs. Are you in control of your you know, total construction process, or are you still using tell us about it.
We use third-party GCs, and they're some of our, closest relationships. There's some tenants that have GCs that have worked with them for, years, and so we'll use that GC on our side of the work, and then it can easily transition into the tenant side as well. So on most projects, we don't deliver them turnkey. We deliver the building with some sort of shell, and then the tenant goes in and does their finishing touches. And when we've had really good success of using the same general contract that they'd use for theirs as well. So then it's just a seamless transition and there's no conflict of, turnover and people pointing fingers because it's just one group doing it. That's trusted
Got
by
it.
both parties.
Understood. Interesting. I like it. I mean, you're really giving us the interior workings of how to grow a successful, you know, with tenants, leasing, medical offices. Tell us a little bit about the diversification of your portfolio.
Yeah, so we focus on two product types, really retail and industrial. On the
Retail
industrial, it's
industrial.
small bay. On
Hmm.
retail, it's single tenant and strip center.
Got it.
We in 2018, I believe, started working with medical marijuana dispensaries in the state of Florida, and one of our largest verticals has been working with them. They spent a lot of years being underappreciated by other developers and investors due
Got
to
it.
some of the regulatory challenges around them. That was a huge opportunity for us because these were really high quality tenants. They have to be vertically integrated in our state. So in California, a mom and pop can just open up a weed shop and throw
Right.
some name on there and just start selling. In Florida, you have to grow it, manufacture it, distribute it, then sell it. So we call it seed to shop.
Got
So,
it.
these are pretty professional organizations that weren't quite getting, the credit that I think they deserved for, the
And
scale of their
tenants.
operations. And they were really challenging to find sites for. Every municipality was different. Some just flat out outlawed it. Some said,
Right.
it had to be a pharmacy. Others said it was retail, but it couldn't be within X amount of feet of a church or a
Got it.
school or residential. So there wasn't much synergy across municipalities, but that created a real opportunity for people that are willing to put the work in.
Right. Yeah. No, a buddy of mine, and he went through the same thing. He got the first 4, 5, 6 recreational licenses in Boston, right? But yeah, it took 2 years for him to get the sites up, though, because of the municipalities, right? They wouldn't allow it. They wouldn't do this. It was this. It was that. It was at one point he found a unincorporated piece of a county and was trying to make his own city. He went through that. So what I'm hearing is riches and niches, right? And yeah, that's
Bingo.
what they say, riches and niches, right? I only deal with high net worth commercial real estate, entrepreneurs in high risk coastal states. That's what we do. We fix their NOI and insurance. That's it. I don't do garage keepers. I don't do automotive dealers, right? Things like that. So And how far did you take it? Because like again, you probably helped them with the zoning. You had to do all that, right? And then you said, "Hey, we can handle this." And you also believe that the industry was here to stay, which it is. I see that, right? Interesting though, right? Riches and niches. And okay, so if we look at asset classes today, are you still with that asset class
We are. They're not growing
and
as
a
quick.
tenant? Right,
Yeah, they're you have to be a little more particular. I think the green rush is somewhat over within the state, and
right.
it didn't pass to be rec last November. So there's been some
Yep.
resets with some of the tenants assessing their growth strategies, but there's still some really quality tenants that we built relationships with that we're continuing to expand with. This year
Hmm.
we've done maybe half a dozen sites, and we have a few planned for next year as well. And these are buildings that we're buying and renovating, and it's single tenant or strip centers that we're working with them. We don't really do many ground up with them because generally, they want to be open pretty quick once a municipality either opens or there's a market they want to jump into because the
Right.
competition is pretty high.
Any other niches that you found? Or let's say, well, go ahead. Any other niches? Any other new
Yes.
trends? Like you called the green rush, right? Is there another rush going on in Florida?
I think the trend that everyone's aware of, but it's we're still exploring it, daily, is the impact on inflation across the state and across our industry. And what we're learning is that it's really kind of clumpy. Um, as it works its way through the economy, we're seeing opportunities that are just people that haven't really appreciated the inflationary effects within cities. And you combine that with, some of the economic growth you're seeing across the state as well. It's almost like a magnifying glass on the potential returns you can have on investments.
So when you're looking at the for other simple, people, the inflationary on the assets, are you talking about rents that are down? Are you talking about gross revenues on, outbacks, right? That they may not have if Outback, went from 2 million to 3 million in revenue, right? Then obviously the lease is coming up and it's a triple net, right? They could take are you tell us a little bit about what you mean by the inflationary elements besides construction costs.
Yeah, the
Right?
construction costs are the downside.
Uh, right.
The
I
uh,
know. The opportunity
the
side. Yeah.
yeah, the opportunities is really in rents, and it's tenants that aren't keeping up with market rents because of their lease structure. Or
Mhm.
tenants are seeing their revenues increases, due to inflation. So there's some unique examples that I've seen where we acquired a property that it was an industrial asset, and our rents were $7 gross per square foot, and across the street, literally across the street, same vintage building, same size suites as us, they were $11 net. And it
Wow.
was just, naive
Right.
sellers who, weren't quite paying attention. And it was a multi-tenant building. So when we acquired it, we went to our tenants, they'd shorted from leases and said, "Guys, you're obviously below market. I'm sure you're aware of it. We'll give you a
Mhm.
chance to go and look at the market and, see what's like out there. We want you to stay, but we always give them enough time for them to make the decision what they wanna do." We don't wanna pressure anyone because 'cause we're trying to build relationships.
Right.
So they have a chance to go and look around the market. And we get tenants to come back and say, "We knew we were below market. It was a hell of a run. We're glad that we were, and, we made a lot of money, and now we're, willing to step up to market because we still give them the best deal to have them not move." We had
Got it.
other tenants that their whole supply chain below them hadn't caught up to inflation. So, they come and say, "We need 6 months, 12 months because we need to change our business model now." And we realize that our competitors had already increased their prices and they haven't. And so
Wow.
when you look at it from that perspective, there's a whole supply chain that was unaffected from inflation due to, possibly the rent just not going up.
Right. No, interesting. Right. Because they didn't raise it. Okay. So that deal, was it on the market and the broker didn't give you a performer rent and try to sell you on a performer cap rate? Or was that something off market that you guys find through your acquisitions?
That deal is off the market, yeah.
Right. That's what I thought.
Yeah.
That's a little right. No, I mean, listen, that's I the best deals I've ever had were off market, right? And things like that. So going back to classes, is there anything that you are avoiding right now? Because like we go pre-COVID, right? Everyone thought retail was going to be destroyed, but what's funny is retail, or even before that, we said the mall was dead with Amazon, right? But what really died is office, right? Is there
Uh,
anything, yeah. Is there anything in particular you're going after today as far as an asset class? Anything you would avoid?
so we really like small bay industrial from a real estate fundamental play. A
Okay,
lot of those projects that we acquire, we won't necessarily acquire with, a tenant in tow per se, because a lot of the tenants are, blue collar, 3 to 10,000 square foot, local or regional tenants. And, it's a diversified tenant type, and they're good properties that are hard to replace. They're not really zoning more industrial land in most places, and the small bay projects are really expensive to build right now with where construction costs are. So you're able to buy projects that are a little older vintage, but still pretty functional,
right.
for well below construction costs, and we're seeing a lot of rent pressure, increasing. We
Right. No,
also
that
really
makes
like
a lot of sense.
retail.
Supply demand, and you're buying it. So you're buying way below replacement cost. That's what we call like buy real estate by the pound, right? By the way, you're talking about joist and masonry building, or are you talking about a steel building on a lot of those?
We prefer so we don't really do much tilt wall, because
Right.
those projects are priced pretty competitive, and they tend to be larger and newer vintage. We do a
Got
lot
it.
of block to steel and then just general steel buildings.
Gotcha. Do you know off the top of your head what's the cost to build a replacement cost value on a steel warehouse, like a steel small bay?
If you look at land costs and you look at soft costs, rent abatement costs, TI, commissions, all that, I mean, you're right around $200 a foot
Wow.
in, Central Florida and, other markets around here. If you're down in South Florida, where land costs and labor tend to be more expensive, you're probably increasing from there.
Right, right. So we underwrite insurance replacement costs. They've taken us in 24 months on joist and masonry. So masonry wall and wood in the roof, right? Because it's cheaper. We went from 120 a foot underwriting insurance to 205 in 24 months. Yeah, so that affects the values, right? But we fight with them, right? But steel, they'll still let us underwrite 120 a foot. So they're way low, huh? And we use
Well,
Marshall and Swift.
I think you may be talking about the construction costs.
Right. Okay. You're incorporating land cost. Understood. That's
So I have
right.
to, I have to figure everything in. I have to figure out how long does it take to build it. I got to, pay for my debt for that time, brokerage
Okay.
commissions, soft costs to architects, engineers.
Okay. So your 220 a foot is everything rolled in, including
Everything.
land cost.
Correct.
Right. So you're paying 20, 30 bucks, 15 bucks a foot for the land, everything else. Okay. And what about construction costs?
Well, so
Just
I'm saying it's
curious.
all in construction. You're probably 1 to 150, depending on the size of the project.
Okay. Right. See down here, we can't even come close to that. Can't even come close in Tri County. And
Yeah, I
and
know that's
and
tough.
yeah, it's but I like what you said. I like the small bay industrial. I know you can't get that zoning, especially for storage, like of vehicles and like, I'm talking about like even Comcast can't store their vehicles anywhere, right? Like stuff like that.
Yeah.
So, especially in urban density areas, everything. You've
So
never
that
played around.
outdoor storage.
Yeah.
I was saying that outdoor storage you're talking about, that's been a huge pocket of opportunity, the industrial outdoor storage, and it's taken off across the country. Without a tenant in tow, it's hard to underwrite because you're paying a lot of times more for the dirt than you would if the building were on it. And you're seeing people actually demo industrial buildings to create outdoor storage. And so unless you have the tenant in tow, it's a harder challenge for us to underwrite. So we haven't really participated in that too much.
Right. No, it's a friend of mine in Jacksonville bought an old bankrupt Kmart, right? And it came on like 4 or 5 acres, something like that. And that's what they're going to do. They're in self storage. They're going to convert it, and then the back acreage was going to be industrial storage. That story's unbelievable. When they ripped off the roof, they were going to replace the roof. They're going to do it. Someone knocked on their door. Today, it's an Amazon last mile freaking location. It's like they scored like crazy, right? Like, like that was like a $2 million deal that's now I think $18 million because
Oh my
Amazon
gosh.
became, yeah, like crazy. They paid like nothing, and Amazon helped them build it to spec and everything, all because of location, right? And they never got their outside storage, so it hits. But I get afraid, like he's in the middle of nowhere. He calls them food deserts in
Yeah.
Jacksonville, right?
Yeah.
Like there's like 10 miles in between a grocery store, right? And he's doing infill and stuff like that. See, for me, I like scarcity and so on, and and so forth. I was on your website or somewhere. You made a comment, smart capital. What does smart capital actually mean to you? Right? Like for a capital partner, I think you were referring to something of that nature. No?
Trying to think what that would be. The way that I may reference it is when I talk about our investors, I've really noticed a trend of the types of people that work with us. And generally they are either the owners of the businesses that they run or they're, key employees, key salespeople. And they are out there making moves within whatever sphere of career they've focused on. And it's really worked out well for us because most of our investors, if they're not first generation, if they're second or third generation, they're still just like pushing the family forward. And if they are first generation, they're building their families well. And so they're incredibly intelligent. And when they look at us, they just look at us as their commercial real estate arm. So they're doing, whatever they've chosen in life, and they've obviously succeeded very well because we only work with accredited investors. When they talk to us, like they get the way that we look at real estate. They understand it. A lot of them, if they wanted to be real estate professionals, they could. There's no real secret sauce. They just
Right.
chose a different path, and then they come in and they partner with us, and we've seen it be really beneficial because quickly on they learn, how we underwrite deals, and you can start to see like when we pitch deals to our investors, they all kind of rhyme. There may be a different property, different tenant, but the strategy is all kind of similar. Where we're just trying to reduce the risk, and then we get to a point where we can stabilize it and then
Got it.
dispose of it, and go to the next project.
Right.
So it's been an amazing partnership with our investors that are they love the educational content. After a few deals, they know commercial real estate pretty well, and whether they're investing with us or investing with someone else, they just get the fundamentals of it after participating.
Right. I've heard different types of people raise capital. Like some like for example, I'm a professional real estate guy, right? So I talk the talk. I've been doing it myself, but today I've shifted to an LP. Why? Because my insurance business is scaling larger than that, and just a new game in town for me. Do you prefer a professional real estate investor, like, or someone with experience becoming a limited partner like me, or you like the ones that most of your investors are from the outside world, right? Not. I've heard both sides, right? Because some people like me, I can read your performance, I can read you this. I know what an IRR is. I know what challenges you're gonna see. I know what delays can happen. I know what contractors are like, right? So does that work for you or against you? I guess.
Yeah, I mean, we've had success in both. I think both of them realize the value of their time,
Mhm.
and what they're doing is they're investing in our projects, and we're putting the work in and creating value. By having, like I said, a team of 14 people that throughout the whole cycle have their hands on the project and are working through all the details. So that's the number one thing that they care about, whether they're real estate professionals or not. The real estate professionals are great because, sometimes I bounce ideas back and forth off them. They don't want to get into the weeds on our project. They want to make sure that we're underwriting it properly and that we're, hedging our risk and we're not being overly ambitious with our assumptions. But, that's kind of on us initially to making sure we're doing that anyways.
Got it.
And the way that we're structured, we're doing deals that are $1 to $15 million generally. So a lot of times that requires a guarantee on the bottom line from our lenders. And so if you're
That's
thinking
you.
about alignment with a
Right.
GP and an LP, I don't know a better way for it. So we're constantly, gut checking our underwriting to make sure that we're not overly optimistic. And so we haven't had many issues with our real estate professionals on any of our underwriting. The benefit we've seen is if, we do have a deal that there is some sort of value that we didn't quite unlock, while under contract,
Hmm.
they can jump in and recommend tenants or, other people we can talk to and, kind of
Right.
expand our network.
Right. Part of the network, and they help out tenants and so on. Is there, so obviously you don't take all investors. So is there two or three things you validate about an investor before you take them? Because I know you're not just go ahead. What a couple of things you validate. Yeah, no, this is important. We know that. I've had bad investors. Listen, I raised a blind fund too early in 2009 because of the Whamu portfolio, and I did a 10 Black Marlin. I did a $10 million raise equity blind fund because I knew Whamu was going to liquidate that whole big thing. and I only deployed $2.4 million, and I had an 8% compounding prep, right? And I couldn't deploy it because Holland and Knight ended up holding up the whole portfolio, and then only took 60% of it into receivership, and then it took 36 months to deploy. And listen, I took
Wow.
anybody's money. Yeah, that was a mistake. So today I own those $2.4 million that I deployed. I bought them out, and in the compound interest over 24 months, I took the hit, but I own that property today. I recovered, but that was my decision because I couldn't deploy. The investors are on my butt, like yelling at me, and I don't want to deploy to deploy. You know what I mean?
Exactly.
So, yeah. So go ahead. Tell me your experience on that, and how do you kind of validate that today, right? Pick the right investor.
We've been really lucky with our investors, and I think it comes down to the way that we have acquired them historically, which has mostly been through referrals. So, we've been investing in commercial real estate for about 9 years. And when we started, it was typical friends and family. And then friends and family grew to people that, I worked with in the industry, lenders, people higher up at the bank, their clients. And you start to create this web of people that, kind of trust each other, then trust us. So when investors come in, they've almost always known, another investor within our framework. And what's nice about that is you start with a level of trust and you start with a level of validation based on the type of
Mhm.
investor that, we've kind of built within. So, we always have investor calls before anyone comes in. We talked about our process, commercial real estate, make sure they're educated on it. We really
Got
want
it.
to make sure that they understand what we're doing and understand the risks and that they have the liquidity to handle it. So if they only have, a certain amount, then, we'll recommend diversifying, across a number of properties or only putting, a smaller amount in
Got
so
it.
that, there's no concerns. And we tell them up front, how we want to communicate. If we're doing quarterly emails and quarterly distributions, which is generally what we do during development, we may communicate more. And when we've kind of set the intention and the plan up front, it's worked out really well with our investors. So we
Right.
have yet to have
Listen,
a
you
bad
said the
issue with
key.
us.
Yeah, I'm an LP on a deal with a guy that I know for years, and like I've done other deals with him, but he's got one deal like that I put in 24 months ago. They were supposed to break ground. Like the communication sucks, right? Now I've made money with them twice, but like they love communicating when things are good, right? But there's something going on with the site approval, and it's been 24 months, and they had to wait, but there's no communication, right? And it pisses me
Yeah.
off. But I know this guy for 15 years. I know he's not messing around, but give me some communication. I shouldn't have to call. So that it's interesting you said that, and so forth. So if you're still in love with Florida, are you moving into South Florida? Because you made a couple comments, you love it. Are you going out of Florida, or you love Florida?
So
Stan?
as an
Yeah,
investment geographic location and personal, I love Florida. We are expanding outside of it into, whether we're following tenant relationships to markets they want to go to or, similar type
got it.
markets.
Mhm.
We just expanded out to the Fort Worth market for a small bay industrial deal. But
Nice.
overall, I really love the growth we have in Florida, the politics we have. I mean, they've been really pro growth, pro business, so that's been really positive. And then personally, you know, I I've been in Florida for 20 years now. I am looking to expand down into South Florida, move down there because I think that there's a lot of positive energy in South Florida right now. And there's just a lot of people, starting
It's crazy.
businesses,
Yep.
planning businesses. There's so much motivation and it's a good ecosystem to be around when you want to create stuff.
I agree. Listen, I've been down here since 2001, and when I first from New York City and Manhattan, and when I moved down in '01 below Fifth, South Beach was cool, the Miami Beach was cool, Brickell was a dump, downtown Miami was a dump, like, we couldn't even live there. Now, we opened an office in Brickell. I'm down there 3, 2 2.5, 3 out of 5 days in Brickell, believe it or not, and by the way, back then, it was a very much it was either it was like a Hispanic community, right? And then Florida is South Florida. I mean, if you look at my office, it's a melting pot. I got everything, like every little, from, I got Middle East, I got Bahamas, I got Cuban. I mean, I got it all. It's great. It's a melting pot. But now when I go down there, I feel like it's the new Manhattan. It's crazy. Everything has been torn down. Everything is redone. Citadel just moved there. And the feeling is when you walk out the door, like you're seeing suits, right? And you're seeing this. I agree. I think we are the New York of the future. Not to mention Goldman Sachs just moved down. I can go on and on and on and on and on. And it is a city. It's like when we go out, like Saturday night, I went out to Vaina, which is a great restaurant and hotel in Miami Beach. But then you're in an Uber and you feel like it's New York. Like, you know what I mean? Like the high rises, the this. We're about to do a deal on a 400. We're doing the builder's risk insurance on a 458 unit new construction condo hotel with a padel court. We did 888 Brickell, the 90-story. Like it's crazy, right? And
Stuff.
it's all and it's institutional size, right? Like the players that are down here, like we used to write, $100,000 insurance policy, a $25,000 insurance policy on a small bay industrial. These guys are coming in doing $650 million projects, $450 million projects. There's a piece of land in Broward, yeah. So the numbers and the sizes for us, like I asked myself, which I know you're going to ask yourself this too, is what's the highest ROI for my skill set, right? Because we used to do a lot of like mid-market clients in real estate, right? Like, somebody owns a $2 million property, we insure it, this and that. But like, it's like saying, okay, if I take on $100,000 client and I'm a digital marketing company and I increase the revenue by 10%, right? And I take 20% of the increase, I made 2 grand. But what if I take on a $100 million company, right? And I increase the revenue by 10% and I take 20, but now I made $2 million. So it's weird that we're talking about South Florida and you're coming is because 36 months ago, the volume of that size wasn't here. I would have to chase family offices to do our magic with insurance, right? Increase NOI and all that. Today, it's like I can't go to enough family office events in 1 week. Like it's like, so you and I have been talking about this. It's real and it's at scale. So the highest ROI for me, all of a sudden, is add 3 zeros to everything. You ever think
That
about that?
works.
Yeah,
That
well, because
works.
I saw a couple quotes you had. Yeah, so I know we're of the same mindset, right? Because it's a similar ROI, and that's where it leads me to my next question. What's a mindset or belief that helped you scale compared to your competitors? Because you did $275 million in a very short time. So, what would you say is the biggest key to your mindset here?
So I'd say recently what I've really been focusing on, and I saw it just naively, when I started, was that most negotiations can end in a win-win. You just need to really understand what the other side needs.
Love it. Right? Go
I'm
ahead.
assuming you're going to show me something right now saying that. There you go. There you go.
Love it. Right.
That's it.
Love it. Yeah. Go ahead.
That's it. Well, so I mean, you know it. I think sometimes the other side doesn't even really know what they want. They think they want something, but through the conversations, you start to learn what actually drives them. And most of the time, it's different than what you need or want. And as us learning that, it's really helped us make deals work that otherwise wouldn't have. And so
Love
that's been
it.
a real positive for us getting what we need, because we don't need everything. We just generally need to produce, as low risk as possible returns for our investors above a
Right.
certain metric.
Right. And most of those people you're raising money from, like I heard what you said, you're doing a lot of personal guaranteed loans, right? You're using lenders that are local, right? You've got skin in the game. You're signing on the debt. So it's not like you don't have skin in the game, right? Right. Do you have an experience where like the investors feel like they're more powerful than the operator because they're the money? I've had that experience. But to me, tell me about it, right? I don't agree with that.
Yeah, we haven't yet. I invest in every single deal,
Mm,
depending on what liquidity I have at the time. And so I'm in every aspect of the thought, like I'm right there with the investors in it.
uh-huh.
And my team and I, we're constantly communicating on every aspect of it. So when investors talk to us about a deal, we generally know everything going on, at most times, at all times for these deals. So we
Got it.
haven't had a power struggle because Our investors, the way we look at it is, they're in essence jumping on our ship and we're going out to sea and we're their captain, we're their crew. And if there's a storm coming, if we can go around the storm, we will. But if we have to go through it, they're picking us as their captain and crew to go through that storm. And if they don't think we're the right fit, then they should invest with us. But if
Right.
they believe that, then we're going to go through it and we're going to do the best we can to survive it and hopefully thrive through it. But that's kind of the mindset we have with them.
Have you ever had a bad situation? Have you had a loss on a deal or something that you couldn't get through the storm?
We've definitely had storms. We haven't had a
Mhm.
loss on a deal, but we've had bad situations that we saw it coming. We tried to prevent it. A lot of times it's with tenants just not working out, defaulting,
Got it.
um, and we've just had to pivot. And that's where we really lean in on our relationships to readjust, bring the best kind of opportunity to mitigate damages and then expand from it. So yeah,
Got it.
we're thankful we haven't had anything negative happen.
It's
Um,
awesome.
we've also it's been a pretty expansive economic time in the state of Florida. So we've had the wind at our backs for sure.
Right. No, no, of course. But a good operator is everything, right? Like, I'm sure you'd agree with me that even with ChatGPT today and with AI, how good you can underwrite a deal, right? And you can program in the back of a super agent, 15 Nobel Prize winning mathematicians on real estate underwriting from around the world program in and it'll kick it out. But that's what I tell my kids. Like, I'm like, AI is making you stupid, right? Because they don't have that knowledge, right? And
Yeah.
it kicks it out and it says, "Yes, buy me a 6.8 cap," right? But it doesn't work. And if you're not an operator, right? And this so how many years have you been doing this so far? 10?
Acquired my first deal about 9 years ago, not 10
Okay,
years
and
ago.
you're rolling. And what are your average IRRs and what preps, that kind of stuff? Give us some numbers, just curious.
So on the deals we've exited, historically, we've had really high returns. And like I said, the economy has been really strong. Interest rates were low, so we're giving more money to our investors than the banks. But our average IRRs have generally, been above 30%, some, around
Wow, that's
100.
great.
So we've
3 to
had some
5
real home
years?
runs.
Yep,
I'm sorry.
right. 5 year?
On
3 year?
average, the ones we've exited, our hold time has been about 2 years. And
Wow.
so we'll stabilize those. When we look at the cash flow that we get once a project is stable, generally
Mhm.
speaking, there's someone else that's willing to pay more for that. And so, we sell the asset and we do a lot of 1031s with our investors' capital. Like I said,
Got
I
it.
have the mindset that we're there with them, so we're trying to grow their capital along with ours in the most tax efficient way possible.
Right.
So, we
No,
have several investments that were three 1031s deep with investors.
wow, that's great. That's how I made my money. I came down here broke after Wall Street. I did the same thing, fix and flip value adds on duplexes, fourplexes, even houses. And I started with like 110,000 in capital. And with two other partners, eventually in 8, 9 years, we had almost 30 million in equity between the three of us. I mean, 10 each, right? But all that 10, everything was at 1031 because everyone's looking at a cap rate or this, but you know what? It doesn't put equity in my pocket when you're at 120 grand and starting, right? And I mean, I lost a couple $1 million from the tech bubble and so on. So, do you the current deals that you have in the pipeline and your acquisitions? Do you predict these similar types of returns? Because you're talking about you went through COVID and retail, and you still had those kind of returns, right? So,
Yes, but
do you
then
think you
everyone
can?
had money.
Everyone have money. Right, that's true.
Right.
That's right, retail, but not well, you had to get certain tenants, collapse. So on your last 3, 4 deals, are these the numbers you're projecting? Or is it slowing
We
down a little bit? Or you're being more conservative?
we're probably more likely in the 20% to 30% IRRs. And
Mhm.
it's an interesting metric because as time goes by, it erodes that number, right? And so
Right,
if you have a 2-year period and you sell an investment after 12 months and you get a 30% IRR, and then that money just sits in a bank account, well then, maybe it's 15% over 2 years because you didn't make any money on it. Or maybe you made, 5%. So it's a little higher. Where
right,
if you
right,
hold that investment for a longer period, your IRR goes down. But if you're cash on cash, distributions you're making are, let's say, 8 to 12%, which is kind of what we shoot for.
That's
Well,
huge.
then the money's still working for you. So your IRR may not be the same, but your multiple's increasing, your cash on cash is staying in the bank. So we
Right.
look at each deal differently. Some we fix up and we flip out. Other ones, we want to hold for a little bit longer, ride that, strong cash flow. And then when we
Got it.
sell it, the IRR may be less, but the multiple's higher. And, the investment meets our investors' needs, generally better than something quick.
Wow. No, I mean, listen, Nick, you got a killer track record. So the real reason I got you on Real Estate Profit Boost is because he only lets people he likes on, as a LP in his deals. Listen, I make I'm literally an LP all the time now. Why? Because I'm trying to focus on growing this place to $100 million. And like, if I'm out buying real estate, so that I kind of went through that chapter. So that's one of the reasons folks out there are listening is, as this show, I've got, I don't know, about 30 episodes now. I only bring real people with values and integrity that know how to execute and also can be, make mistakes and know how to pivot and get out. Right. And that always leads to a certain question. Like, and so many deals get thrown on my desk, right, as an LP, and I have clients calling me, like from the insurance side, like, "Hey, Jerry, I know you help raise money. I know your podcast. I need this," but like, it's not about underwriting. It comes down to, like, I always say this: are entrepreneurs or operators, are they made or they're born? Only like 1% actually execute, no matter how good performers look, right? And Nick, you're one of those guys. So I just want to, first of all, congratulate you, dude, because you kicked ass like in 9 years and you did good and everything. Those are great numbers.
Thank you.
So, and yeah, no, really. And Real Estate Profit Boost, has a lot of good people out there watching and limited partners. So if knowing our audience, who do you want to connect with out there? Brokers, operators, family offices. How do they connect with you? You look, capital partners, opportunities, regions. Go for it.
So we love building our network, and we build it across all aspects. So we are starting to increase our investor base more, and we're starting new initiatives to expand that because as we grow our reputation of performance, we're starting to see a lot more opportunities across different cities, different deal sizes. So we'd love to connect with anyone that's interested in talking about real estate, talking about investing in our deals, learning more about it. So that'd be one segment for sure. The brokers we work with have really helped make our business. We look at them as really key individuals. When they bring us a property, we talked about it earlier. There's got to be some sort of statistics behind it. So there's always got to be a story. And so every project we work on, there's a story of why it's mispriced and misaligned with the market, then how we can capitalize on it. So if there's broker relationships in that regard, I'd love to talk to them. We're expanding our lender
Awesome.
network. We have about 30 lenders we work with right now. We know all of them pretty closely, and they help us put our deals together. Because a lot of times when we have these value add deals, the loan terms may be a bit unique, but because we have that relationship, they'll give us a little longer IO period. Maybe the debt coverage ratio covenant doesn't kick in until month 36. There's a number of different levers we like to pull for that to
Got it. That's
optimize the
awesome.
return for our investors. So
Right. Do you have any bank relationships that waive certain insurance requirements? Because if you do, that's what we're always looking for. We establish those, like
okay.
credit unions, yeah, life cos, or even private lenders that go out at a decent cost of capital, but they'll remove 60% of the fluff, right? And a lot of it is fluff, like especially if you're going non-recourse, fatty, CMBS and all that kind of stuff and so forth. Okay, where's the best place to reach out to you? Websites, go ahead.
So
Emails.
easiest is our website. So our company name is Alakai Capital. So the website's www.alakai, which is ALAKAI dash capital.com. I'm also
Where'd you
active
get
on
that name?
LinkedIn.
Alakai.
And,
Your
it
kids?
was no, it was
Okay. Uh-uh.
it's branded around the type of organization I want to lead. So Alakai is the Hawaiian word for the village leader or the village guide. And
Wow.
for myself and my team, I want to hold all of us to a high standard. And so, whether it be our investors, our tenants, our, various contracts we work with, we want to be those people that stand there as, their guide or, their leaders through whatever, we're going through together. So it's a
That's
testament to the
awesome.
culture we're building.
I just finished the show, the first season of the Hawaiian, the guy from, have you seen the show?
I know the one you're talking about.
Dude, it
Yeah.
was great. It was great.
He's
It's
like
the guy
he's
from
like the warrior.
He's the guy from Aquaman,
Yeah,
right? And it's called like Warrior Chief, right? And it's the story of the Hawaiian Islands. Now I get it, right? And how they were all
exactly.
separate and everything. If you haven't seen it, it's good from the first episode, right? I was hooked, but it's really good. So interesting. That's freaking Alakai. Okay.
Malachi.
Obviously, everybody out there, all of his stuff, all the descriptions are in there below. You want to reach out to him, anything like that, everything's down below, and you think I'm joking, right? But I'm telling you, one of the reasons I got you on here is so we can invest with you. So keep that in mind, because I only do it with the right people. I vet operators, right? And I don't vet deals. I learned that a long time ago. And to be honest, between you and me, Nick, I don't think I've ever lost money in real estate. And that's not only on my own deals, but also as an LP, right? There's been snafus, and I've stepped in and said, hey, let's do this, or hey, let's get a tenant because I'm a real estate guy. But I agree. And that's why on Real Estate Profit Boost, I kind of pick and choose. You didn't know that, right? Because we met through EO a couple times and so on. But that's one of the reasons here and so forth. So for the audience, right? If you're still thinking about cap rates and comps the way you were 45 minutes ago, right? Then you weren't listening to Nick. It's true. Nick Jones just laid out the exact playbook he's used to build a $275 million portfolio in a market that most people like me, like Orlando, are too scared to even move in. So here's the ask. If you're serious about deals, capital, expansion, connect with Nick, right? His company's building properties, they're building momentum. And if you're in South Florida, you're right, then, he's coming down here too. So DM us if you want to connect with Nick. We can connect you directly, or subscribe, to this show. You'll see more of Nick and other people like Nick. And don't forget, share this episode with people, because this is a learning community, not only for investing with Nick or investing with me or insurance and things like that. The secrets that you hear from a guy like Nick that came from wakeboarding to building a $275 million or more portfolio and continuing to go are critical in mentorship and learning. And that's why Real Estate Profit Boost exists. So, Nick, thanks, brother. That's
Thank
it.
you.
Right. It was awesome. And I really appreciate you being here. And again, everything's in the description. So we're out.